How we all doing? I haven't gone live in a little while, so type 1 if you can hear me. Type 1 if you can hear me right now, just making sure everything's working before we go ahead. We all good? Okay, awesome. Well, today I wanted to do something a bit different, do a live stream because we got some breaking news that's going to absolutely change everything for the markets and the economy. And what we're going to talk about is the jobs market. We just got some new data, and it's very, very interesting to see what's starting to happen because the last pillar really holding up the economy was the jobs market. That's what's been holding up the housing market as well. People haven't lost their jobs, and we haven't felt the lag effects from all these interest rate hikes from what the central banks have been doing, because it normally takes about 6 to 12 months before we start seeing the full effect of these interest rate hikes in the economy. Now, what these central bankers have done is they've lifted interest rates to 5%. Now, 5% may not sound much when you compare it to interest rates between 15 and 20% in the 70s and 80s. But the thing is, debt is 3 to 4 times higher now. So if you look at it, interest rate now of 5%, with debt being 3 to 4 times higher, is kind of like the same effect on the economy as when we saw interest rates hit between 15 and 20% in the 70s and 80s. Because remember, back then, debt to GDP was only around 30 to 35%, where today it's around 120 to 125%. So again, the last thing holding up the economy was the jobs market, and I've been warning about this is going to be the last thing to fall before we start to see the real downturn in the economy. So without further ado, I've just been waiting for everyone to tune in. I hope you're having a great day or had a great day if you're watching from Australia. If you're watching from the US, I hope you will have a great day today. And let's get straight into the news, the facts, and the data or data, however you want to pronounce it. So look at this, everyone. Unemployment rate unexpectedly rose to 3.8% in August as payrolls increased by 187,000. Now, this might be a bit of a head scratcher for you. What? The employment increased, but the unemployment rate ticked up. Well, the reason for that is more people are now joining the workforce when you compare it to 2020. They're back up to 2020 numbers because what did we see in 2020? A lot of people made a lot of money in the stock market. They made a lot of money in the housing market, so they retired or left the workforce, or maybe they were afraid of the of COVID or the COVID restrictions, mandates. Maybe they didn't want to go along with that. But now a lot of people are starting to return to the workforce because they have no choice. The cost of living is skyrocketing. It's people really doing it tough. They're living paycheck to paycheck. So they've got no choice but to jump back into the workforce. So that's why even though jobs have increased, we're seeing the unemployment rate tick up. Now, what you have to know is it's been quite funny what they've been doing. They'll put out this, there's 187,000 jobs created. But I would not be surprised if we see quietly next month or the following month that they revise these numbers much, much lower. But let's dig a bit deep into this report, everyone, to see what's really happening. Okay. So we look here, the real unemployment rate. So again, it increased to 3.8%, up significantly from July, and the highest since February 2022. But the real unemployment rate, and again, this is the government figures. So I think the actual real unemployment rate is even higher than this, but it jumped to 7.1%. Now, some of you may have been affected by this. Some of you may be really struggling. So I do encourage you after this live stream to go ahead and watch my last video I just did, which hopefully gives you a bit of hope during these hard times. So what industries saw the biggest gains? Well, healthcare showed the biggest gain by sector, adding 71,000, and other leaders were leisure and hospitality, social assistance, and construction. Okay. Now, this is going to have big consequences for central banks. We're going to dive a bit deeper into this report. I think the Federal Reserve is going to pause even though I think that inflation isn't officially over yet. We're seeing gas prices increase. I think I saw an article I was reading earlier today that they've hit their highest level since 2020, and especially coming up to Labor Day, gas prices are still up over 20% when you compare them to a year ago. But let's have a look at some charts here, everyone. So as we can see here, I'll just go ahead and move myself. We can see monthly job creation in the US, and we can see we are in a downtrend here, everyone. And again, what they keep doing is they'll put out, some decent jobs numbers, but then they'll revise them lower the next month. Also here, I'll go ahead and move myself again so you can see this chart. We can see year-over-year percentage change in average hourly earnings in the US. So also people's pay rises are going down as well. And that was up 0.2% for the month and 4.3% over the year. Now, again, this is not keeping up with inflation, and this is why so many people are struggling. And yes, while we are having jobs created, it's because a lot of people are having to work 2 or 3 jobs, not to live a luxurious life, not to go out there and spend on luxuries or holidays. This is just to pay for the essentials: a roof over their head, utilities, gasoline, petrol, and a few other, maybe food, or maybe going out once a week. They're not really living it up. But if we go ahead and have a listen here, the unexpected increase in the jobless rate came as the rolls of the unemployment grew by 514,000, and the household count of those unemployed or employed increased by 222,000. So we can see here the unemployed grew by 514,000. And the employed only increased by 222,000. So that's why you need to dive a bit deeper into these reports and not just look at the headlines, because, with accounting, they can play with the numbers a bit. So it says here, August jobs reading comes at a pivotal time as the Federal Reserve officials look to chart a course forward for monetary policy. Again, what I think they're going to do, I think they're going to pause, but we still are so uncertain whether inflation is going to fall back below 2%, or if we're going to see one last tick up in inflation. And if gas and petrol prices keep going up, if the price of oil keeps going up, I think it definitely is a risk. But I also do have to admit, if we do enter a severe recession and a lot of people, lose their jobs, people aren't going to have money to spend. So we're simply going to see inflation fall, and then we may see the money printers start to come on again. And what's funny? We got this report out that the unemployment rate is ticked up, and it's funny because Wall Street seems to love this. I'll go ahead and go to the markets here. We can see the Dow is up 200 points, the S&P's up 5.9%, the Nasdaq's up. The bond market is up very slightly, just 5 points. Crypto's actually sold off a bit. It's pretty flat at 25,900. But oil is up, which again is a risk for inflation. Oil, we can see here, Brent crude is now $88, and gold and silver is pretty much flat. But again, it's quite funny. Wall Street, a lot of the rich oligarchs, they want you to be unemployed, so then that way the Federal Reserve can cut interest rates and start the money printers again, just so they can get an increase in their portfolio. And again, this is why inequality is getting so out of control, and why people are really doing it tough, because the way the monetary system is set up is they print the money, pump the markets, the banks get the money first, they go ahead and lend it out, they buy up all the assets, and by the time it trickles down to people and they finally start to get pay rises, like what we saw over the past year, well, then they go ahead and sell at the top, they crash the markets, and they go ahead and buy assets for a discount. Now, again, this is just how the system is created, but if you know how they play this system, you can also take advantage of it as well. So let's keep on reading here. So markets widely expect the Fed to skip a rate increase in its September 19th to 20th meeting. However, the market pricing still points to about a 38% probability of a final hike at October 31st to November 1st meeting, according to CME Group data. So we'll have to see what happens with inflation and what happens with the unemployment rate, because if we see a weaker inflation report come out, and another badge jobs report come out, obviously they will pause for the rest of the year. We may even see cuts in 2024. But if we do see inflation tick up again, well, then that's going to make the rate increase in October and November much more likely. And while I'm reading this, what do you guys think they should do? Do you think they should keep lifting interest rates? Do you think the central bank should keep lifting interest rates, or should they start cutting? So type 1, if you think they should keep lifting interest rates, or type 2, if you think they should start cutting interest rates. Let me know in the chat. Well, I'll go ahead and keep reading here. So, like I talked about previously this week, job openings, for instance, fell to 8.8 million in July. That's still well above where they were before COVID, but is the lowest since March 2021. Also, as I talked about, the PCE, the Fed's preferred inflation gauge, obviously they like that because it's the lowest. So I'm just reading the numbers here. Pretty mixed bag between lifting interest rates and cutting rates. And I agree, it's very uncertain right now. But I think it is more likely that we'll see cuts next year in 2024 than rate increases. Because the PCE, as we can see here, that equated to a 3.3 12-month gain, or 4.2% when excluding food and energy, because who needs food and energy, everyone? That's not important. The core level that the Fed thinks is a better measure of longer-term inflation. So the department also reported that gross domestic product increased at 2.1% annualized. So again, the GDP was revised down from their 2.4% estimate. So okay, I know you're thinking, everyone, what does this mean in simple terms? Well, what this means is, everyone, we've gone from an environment where inflation has been surging, and don't get me wrong, inflation is still high. Cost of things is still going up. There's still inflation. But what the Federal Reserve looks at it, and what the central banks look at it, is how fast the price is going up. Now, don't get me wrong, they completely manipulate the data, but you have to go off the data they use, because that's the data they're going to use to make the decisions. So going off their data, they're going to look at this and think, wow, we've actually lifted interest rates, inflation is falling, so you're going to start looking at cutting, I think, in early 2024. Now, how you can benefit from this is if they cut because we have a recession and companies' earnings fall, well, then that could be bad for the stock market. Now, some stocks will do good. It's going to be a very mixed bag, but I think tough times are definitely going to be coming ahead. And what I think a benefit from this is gold and silver, because if they start cutting interest rates and the dollar falls, which is the only reason why gold and silver hasn't been going up, because when the dollar goes up, that's bearish for gold and silver. But if the dollar falls and they start cutting interest rates and we enter in a recession, that will be good. But say, for example, you have to hedge your bets, because I could be wrong, you could be wrong, the central banks could be wrong. They have been wrong a lot in the past. Well, what happens if inflation is still high, but the Federal Reserve all of a sudden changes their mandate? Or what happens if they manipulate the data and, prices are going up 5-10%, but then they say, you know what, inflation's only 2%, and we see a market melt up? Well, then that's when you want to have some assets in your portfolio that would benefit from what's called a risk-on environment. And that's why I diversify into Bitcoin. And I think, the Bitcoin community and the gold community tend to fight a lot with each other, but really, we got the same goal. We don't like the way the monetary system is. We don't like the fractional reserve banking system. We don't like the centralized control of the government and the central banks and how much control they have over the financial system. So we both want a decentralized financial system. And you can do that with gold, physical. You want some physical gold and some physical silver. And you can do that with Bitcoin as well. Don't keep it on the exchange that, could get hacked, or we could see like what we saw with FTX where they stole people's money. But you can actually self-custody Bitcoin by holding it in your own cold wallet. Nobody will know the private key but you. And this is the play that I'm doing to protect myself against a recession, but also a market melt up as well. And maybe even have some gold mining stocks or some silver mining stocks, some lithium mining stocks in there as well, but a small part of your portfolio. So everyone, again, what this means is, for those that are just tuning in now, the unemployment rate has unexpectedly, which I think we all knew was coming, has ticked up to 3.8%. There was 187,000 jobs created, but that's not enough to offset the people coming in to the jobs market or those people that are now unemployed. And again, this has been the last pillar that's been holding up the economy, has been the jobs market. And again, for the housing market, interest rates have been soaring, and even me, I've been shocked to see how resilient the housing market has been. But what they've been doing is there's been very low supply, and what's happening in the US and Australia as well, we've seen record migration, whether it's legal or illegal migration has been surging. So that's absorbed a lot of the supply, and there's not much supply. But if we see people laid off and then they're forced to sell, then we're going to see supply in the housing market tick up, and we will finally start to see that correction in the housing market that we've been waiting so long for. But everyone, it's been great chatting with you. It's been great doing this live stream. I hope you've enjoyed chatting together in the live chat. It's fun to mix it up sometimes and do something a bit different. So everyone, thanks for watching again. If you're affected by this, if you're going through some hard times, please watch my latest video that I just uploaded. I hope it gives you some hope. Thanks for watching, everyone. I'll see you all in the next video.